Well, despite all the press that the FOMC meeting's getting, and certainly we'll focus that on a second, most of the market moves actually took place after the CPI number that we saw. Ex-food and energy came in at 1.7%. So that's the third month in a row we've seen a bit of a soggy inflationary read. And when we're seeing inflationary trends falling, we've seen inflationary expectations falling to the lowest level since November. The Federal Reserve are loath to raise in a situation where falling inflation expectations are occurring. But we have seen interest rates moving up. But as I say, most of the moves that we saw in the fixed income market with long-end treasuries yields getting absolutely slammed, huge outperformance from the back end of the curve there, significant flattening of the 210 curve, and certainly a really strong sell-off coming through in the latter contracts of the Fed funds futures. And the US dollar obviously coming along for the ride to the downside. But the Fed meeting in itself, I think, can be categorised as a hawkish rate hike, at least relative to expectations. What they've raised their growth forecasts. Okay, so we have seen them revise modestly lower their core PCE numbers for 2017. That's not going to really surprise given the inflationary numbers we've been seeing of late. But they have kept, by and large, they've kept their dot plot projections unchanged. They're still expecting 3 rate hikes in 2018, and they're still expecting 3 in 2019, and the longer run average should be around about 3% or just under. But the market is still very, very pessimistic. And why? Because of inflation. Inflation now takes on new meaning within the Federal Reserve, and I think there's not just a growing disconnect between the market pricing, but also between Janet Yellen and the wider collective. I think she's kind of becoming slightly more pessimistic on inflation. She wants to see it moving up. She's kind of prove it mentality rather than expect it, which some more of the more hawkish members are saying at the moment. The Federal Reserve are expecting inflation to move higher. They've said that, through mathematical arithmetic calculations, it should move higher from here. But the market's not so sure at the moment. If you have a look at market pricing through the Fed funds futures, we can see 1 rate hike priced in next year. We can see a 70% chance of 1 priced in for 2019. And we've got only a 47% chance, or a 50-50 chance, should we say, of a rate hike, another one this year. So the market is very, very pessimistic, and I think rightly so, because people are concerned about these inflationary trends. We've seen that curve flatten. We've seen the Fed funds curve flatten. Oil prices are coming down to $45. That's going to be deflationary from the business spending capacity that we've been seeing there as well. So I think inflation now takes on new meaning. The market is going to be so sensitive to core PCE reads, inflation or CPI, ex-food. Those kind of numbers now are really, really sensitive to market pricing. If we see the market inflation picking up as the Fed expect, there's going to be a screaming short coming through in the Fed funds market. Long-end interest rate markets, the 10-year, for example, should sell off quite aggressively. But if that doesn't happen, we could see the 10-year trading down to 2% and perhaps even below 2%, and getting down to some of these very, very hawkish or bullish calls that we've been seeing from the likes of HSBC for 190 on the 10-year. The US dollar, which has been under all sorts of pressure at the moment, if we genuinely believe the Fed are going to raise rates 3 times next year, which is what the consensus is in the market amongst strategists and also amongst the Federal Reserve, the US dollar is a screaming buy. US 10-year, 5-year treasuries are a screaming sell. But there's no certainty that's going to happen. What happens if there's a macro shock at a time when inflationary expectations are falling? So the playbook is so wide and so diverse, it's unknown really what to happen. But I did take the narrative from the Fed that they are confident we are going to see a snapback in inflation as a hawkish shift, and the failure to really move the dots has really been taken quite positively as well. In terms of our open this morning, I think it's interesting that we are calling the market down 30 points. Healthcare looks absolutely breathtakingly phenomenal at the moment. That's broken out to new all-time highs. If we see weakness in that index today, I'd be waiting to see if we get a rebound off the previous all-time high. Have a look at the daily chart to see what I'm talking about there. If we see that buying kicking in, go with that and certainly look to leverage into a long trade there. Banks will be interesting. They've rallied nicely over the last few days in line with other global banks. But in the weakness that we're potentially going to see on open here, will we see buyers step in from around 10:15, 10:30? If you do see that, it's going to be an extension potentially of this short-term trend we've been seeing. Mining stocks look like they're going to get beaten up pretty badly. If you look at BHP's ADR, it's down about 2% or so. But I think that's more a reflection of the variability of its earnings, which are explained by oil. So we're expecting energy to get beaten up pretty badly. But the question is will we see this weakness, which we're expecting on open, to transcend descend into a further sell-off, or will we see people looking to buy the dip? That's the question of the day. I expect to see, my own gut feel is we'll probably see people look to step in onto this weakness when the market opens.